Global markets are very volatile again this morning after Donald Trump threatened another 50% tariff on China. Hong Kong stocks had their worst day since 1997. The Aussie dollar falls below 60 US cents to a 5-year low, and the Kiwi dollar is at a 16-year low. That's coming up in our 5 Things in 5 Minutes on Tuesday, April the 8th. And then in today's bonus deep dive interview, ANZ's chief economist for Greater China, Raymond Yeung, looks at whether this trade war will lead to China pushing even harder for a de-dollarization in its trillions in foreign reserves.
It's not happening overnight in terms of de-dollarization, but this is definitely any change structurally in the global trade regime will also point to the need for China to diversify the portfolio.
But first, in 5 and 5 with ANZ, global stocks, bonds and currencies swung wildly again overnight, with Chinese stocks down as much as 14% after Trump threatened an additional 50% tariff on China. The Hang Seng closed down 9.5% and had its worst day since 1997. There was massive volatility in US trade too, the S&P 500 first slumping 4.7% as Trump's 50% threat came through, and then rebounding on a since-denied report that Trump would pause tariffs. As of 4 a.m. Sydney Melbourne time, the S&P 500 is down 0.4%. Here's ANZ head of G3 Economics, Brian Martin, on the S&P being only slightly down in afternoon trade.
Maybe there's just a little bit of optimism in markets that, given the huge amount of negotiation that is going on in the background, possibly there could be a little bit of a thawing to allow some space for the negotiations to take place.
As of 4 a.m. Sydney Melbourne time, the US dollar index was up around 0.3%. The Aussie dollar was down another 0.8%, below 60 US cents at 59.95 US cents, a 5-year low. The Kiwi also fell 0.8% to 55.46 US cents, a new 16-year low. Another big mover was the US 10-year Treasury yield, which rose 17 basis points to 4.17%. Brian says many fear the Fed won't cut enough or fast enough to arrest the market turmoil, because it wants to see that tariffs aren't too inflationary.
I don't think you can bank on the Fed cutting interest rates instantaneously because markets are weak. And I think that's sort of fed into the bond market a bit, and that's helped to push bond yields higher.
Number 2, China is preparing stimulatory measures for both consumers and exporters in response to Trump's tariff shock and is set to front-load some stimulus, says ANZ's chief economist for Greater China, Raymond Yeung.
We expect they're going to perhaps issue 1 trillion renminbi of special government bonds in order to support domestic demand and consumption. They may also use the money to support exporters as well. We also expect the central banks to cut the reserve requirement ratio by 50 basis points very, very soon in order to calm the market.
Number 3, there's also some speculation China will engineer a devaluation of the renminbi to help cushion the blow, especially after the People's Bank of China nudged the currency down versus the US dollar in its currency fixing exercise last Thursday and again on Monday. Raymond says China is more likely to opt for some domestic price cuts and currency stability in the longer run.
Overall, I do think that stability is still the key priority of Beijing, and they're not going to use massive devaluation as a way to offset the impact of the US tariff, because they're also concerned about the potential capital outflow from China.
Number 4, one big shift in prices that hasn't gotten the attention it normally would get in recent days is the oil price, which has fallen 15% since last Wednesday to around $61 a barrel for West Texas Intermediate this morning. ANZ commodity strategist Sunny Kamari says fears about global growth are a factor, but oil has been hit by something of a double whammy.
This decline was further exacerbated by a surprise decision from the OPEC Plus alliance to increase supply by 3 times the planned amount from May. While the market is likely to remain volatile, as it will take weeks to fully understand the impact of these tariff changes, we expect prices to stabilize near $60 per barrel if the situation turns out to be better than feared.
Number 5. Meanwhile, in Australia's jobs market, the ANZ Indeed Australian Job Ads series found a 0.4% rise in March. That offset a 0.1% fall in February, indicating stability at levels above the long-run average, albeit down about 8% from a year ago. Here's ANZ economist Aaron Luke.
What the data is telling us is that demand for labor is still very high. The unemployment rate remained at 4.1% in February, and we know that the availability of labor has been an issue for businesses for quite some time now. So today's data shows that job ads have increased the most for retail and sales sector. We also saw the tech sector rebounding a little in 2025. So with elevated job ads, we think that the labor market will remain relatively tight in the near term.
Aaron Luke there. Now, in today's bonus deep dive interview, ANZ's chief economist for Greater China, Raymond Yeung, looks at whether this trade war will lead to China pushing even harder for a de-dollarization in the global economy and shift its reliance on storing its currency reserves in US dollar assets such as US treasuries.
If the US is really going to be a protectionist and if the currency remains the base currency for global trade, I think lots of countries, including China, especially for China, which is a major holder of US government securities, will need to review the allocation of the foreign reserve. Now, in the past, because it is very natural for them to recycle the current account surplus or the trade surplus with the US back into US dollar assets. The US dollar is the main currency for cross-border trade. But in the future, is this recycling still a valid proposition? I think that's probably the Chinese policymaker would take these opportunities as an opportunity to review their currency portfolio. So I'm not saying that they are going to sell off US Treasury as a way to threaten the US, but I'm just thinking that it is very natural, even for us in the markets, to think about whether this trade recycling in US dollar remain a proper proposition to support global trade, because, bear in mind that a lot has been saying that the privilege that the US has been enjoying in the last few decades, because they are able to print money to support the current account deficit, for decades. And now if there is a change in the global trade structure, then for China, which is holding 3.2 trillion of foreign reserve officially, plus some other hidden reserve, perhaps deposited in other countries, especially in Belgium, that would also be a good time for them to think about diversification of their foreign reserve if there's a change in the trade structure in the world.
And what are the options for China if it does decide in the long run to diversify as well as increase the use of the renminbi in trade?
The US dollar has been enjoying the privilege as a global trade currency because of the depth of the market, the liquidity and ease of use, and the financial infrastructure is all supporting US dollar. So for Chinese policymakers to think about diversification, they also need to consider a lot of different factors. The immediate option for them, of course, as a start, as a pilot, is to allocate some of the reserve to Hong Kong dollar, for example, which is also linked to the US dollar, but is less prone to any, for example, debt ceiling concern that's happening in the US. And also within the same country, it's much easier for China to manage the flow between the onshore and offshore market. So the governor, Pan Gongsheng, January also say that they're going to allocate some of the reserve to assets in Hong Kong. So that is a start. But also, ideally, they would also refer their currency portfolio to the trade portfolio and including a basket of currency plus gold and some other asset in the foreign reserve allocation. I think it's not happening overnight in terms of de-dollarization, but this is definitely any change structurally in the global trade regime will also point to the needs for China to diversify the portfolio as long as they are able to find some asset that is liquid enough and well accepted globally as a currency for exchange.
China has been looking to increase the use of renminbi, not just as a trade currency, but as a reserve asset of some sort. How much more work do they have to do to improve or change the capital markets to make that more likely?
I think at the moment, it's not easy to sell renminbi to other countries as a replacement of the US dollar, and most of the countries prefer their own currency instead of using other countries' currency because they also want to control their exchange rate regime. Even Europe would not be easy to take renminbi as a trade currency, even after more than a decade of promotion and campaign to promote internationalization of the renminbi. But I think in the end is bit by bit, and for some of the countries that do not actually have US dollar on hand, they may be able to accept the renminbi, as a replacement because, China has been actively pushing this campaign to other countries, especially for the Belt and Road and economies will be the target for China to push the use of renminbi or local currency exchange. So for the capital market, of course, China is very active in issuing the financial instruments, both onshore and offshore, to foreign investors. So that will also be another step for China to promote the currency for global use.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, April the 8th. Catch you tomorrow with the latest action on markets. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.